welcome back everyone. I just wanted to do a quick update because I think it's really important. I'm going to talk about the price for a minute and then I'm going to talk about all of the Fed speeches today because it is 3 a.m. U.S. Eastern Standard Time. So I think it's going to be important today, later on today, like 10 hours from now. And that's why I'm making this video. First of all, not financial advice. This is more about learning how to trade and listening to me and my own opinions. I could be wrong. I'm not always right. That's impossible. Have your stops in place. Always have a stop in place somewhere. And do not invest in anything you're not willing to lose or lose sleep over. Equities, stocks, extremely volatile, extremely risky. Consult your financial advisor before doing anything. All right, so I bought the dip, right? I think it was Tuesday morning. Well, technically Friday. Then I got stopped out. Then I bought back Tuesday morning. And let me show you guys so I can prove it. So here I posted this October 1st in the MMG alerts room. 4-hour charts look bullish for metals. Both are 9 buy signals. Blah, blah, blah. I'm buying in for a swing trade to the upside. And the price was 14.68 on gold and 17.08 on silver. So I've been holding since then. And, trade's doing great. I'm definitely up. Because the current price is 15.14 on gold and 17.6 on silver. Obviously, I'm holding gold mining ETFs to the upside, and the percentile gain on those are much, much greater, especially with a margin account and leveraged ETFs that you should never trade if you don't have like 6 years experience. Believe me, don't do it if you don't have experience because you don't understand a lot of things to them. All right, so I bought the dip, right? These are 12-hour charts. Gold's on the left, silver's on the right. They both look positive right now, really positive, especially gold. Gold's on a 4 count to the upside out of a 9 count on the 12-hour time frames. All right. If we go to the 4-hourly, silver looks a little overextended. Let's take a look at gold. And gold's on a 6 count. So, the 4-hourly time frames, they're fairly overextended for both. The 4 hour, the short term, right? Every candlestick's 4 hours. Of course, if you take it to 12-hourly, let's go back up to a daily time frame. Sorry, I should have gone in order. So gold, put it on a daily here. They still look bullish on the daily, okay? And technical-wise, charting-wise, they look bullish. Yeah, they look very bullish. Very bullish. So I'm not very worried about the short term. Except, all right, these Fed chairmen, right, they have non-stop speeches and conferences, and they release articles, and they release Fed minutes, and, people don't understand, why are they constantly talking? You would think there would be one FOMC minutes, like, it should be like a quarter. Or let's say they do it once a month. That's like the only times they should speak. The rest of the time they should be working and looking at their charts, or really just not be in existence at all, in my opinion. But this is proof. I mean, look at this. This is their schedule, their daily schedules, right, in and out. This is proof that we don't have a free market. Because if we did, they wouldn't have to go around talking so much. Because the markets listen to them, and that's the problem, right? Financial markets, the stock market, it's not really supposed to affect the real economy that we live in. Unfortunately, because they print money and blew bubbles, the financial market became so big and so entrenched to the real economy that if the stock market dumps, everyone's going to feel it and the real economy is going to suffer. And it's not supposed to be that way. Like, remember my last video? I said the stock market and the financial services are a byproduct of the real economy. Well, in this upside down world, it's the other way around because of all of this market tampering and controlling and centralizing, and manipulating, right? So, it's not just the Fed; it's the government. It's both of them together. Okay. So tomorrow, this is their website. So 2 p.m. Jerome's gonna speak. I'm not gonna promise I'm gonna go live. I'm gonna watch it, right? If I feel like it, maybe I'll go live. I doubt it though, because I'm probably gonna be busy trading, right? For the private members, I'll be posting. And this is what I'm thinking. So are metals gonna dump tomorrow? Of course they would love to dump metals. But, and not just that, we have a bunch of economic data coming out. So I posted this in the free newsroom, links below this video in the description. There's a bunch of economic data coming out. That's another reason why they're probably talking, to minimize the damages from bad economic data like we just got yesterday and the day before, right? So with the manufacturing. So, okay, this is what the market actually really reacts to this economic data, which is the non-farm payrolls. The U6 economic data, or unemployment data, is also here, which is the one that tells you the true unemployment rate and all that. Of course, I don't trust these numbers. They will skew them and fudge them, and then like 2 months later, they'll go back and readjust them, and it could be a huge difference. So, technically, I don't even know why the market looks at the data. I think everyone knows it's bullshit, but everyone knows that everyone reacts, so it's like a self-fulfilling prophecy again. Yeah, I mean, we have manufacturing payrolls, government payrolls, average weekly hours, U6 unemployment. I like looking at that. Exports, imports, so the trade deficit, private non-farm payroll, average hourly earnings year over year. Yeah, I mean, tomorrow's a big day. I don't know what the economic data is. Who knows, right? So, watch this. I will be posting in the newsroom. So, what am I thinking? I'm thinking if the economic data is really, really bad, they're probably going to fudge the numbers a little bit and make it look better, so they'll be slightly negative neutral. If the economic data is neutral, they'll fudge the numbers and make it look really good. I swear to God, this is how it. And then, if it is slightly negative, they're going to come out and be dovish. Dovish means they're going to be lenient, and they're going to, give the stock market. They're going to give the market like an adrenaline shot to keep the wounded patient going. This is how I view it. This is how you need to view the economy. The economy is like a patient, right, for a doctor. And that patient got a heart attack or something major, right, happened to him in 2008. And ever since then, he's been on life support, which is QE and, artificially low interest rates. And then when the patient's heart stops beating, they just give him an adrenaline shot every time. And those are lowering the interest rates. Maybe he's getting some morphine that's providing liquidity for the overnight banking lending market, right? The repo market, right? So that's how you have to view these things. So basically, what I'm trying to say is, if you have a position on, if you're a trader, today's a big day. And we need to pay attention. I think that they're going to be doves, and they're going to start talking about, they're going to say that they're going to lower rates next FOMC, which is the 29th and 30th of this month. And then they're going to get questions, right? And they're going to hint towards things. And they're probably going to hint towards if a recession comes because of the global, slowdown. Um, will they keep lowering rates? Will they be accommodative as much as humanly possible? They're gonna have to talk about the repos, right? And then they might even hint towards QE. You never know. But if they think that the market needs it, so if we take a look at the S&P 500 right now, right? Here's the S&P 500. You know, I kind of view this is a 4-hour chart. I view this as possibly a dead cat bounce right now. But it looks like it has some great momentum. This would be a great trade to the upside for the S&P and any other equity or index at least. So they want the market to go higher and make new all-time highs. And it's not that far from all-time highs. 3,000 for the S&P 500, right? That's the previous all-time high. It's not that far away. Right now it's at 2,911, right? So for them to make new all-time highs, they're going to have to be pretty dovish. Like today, later today when they start speaking for their speeches. Because if this is a dead cat bounce and it breaks down below the S&P 500, let's say, below 2865, that's where I have it for my 23.6% fib retracement, then the market could easily take out these previous lows and fall all the way back to 2500. And if it does that, the Fed might not have enough juice to get it back up to retest all-time highs. So in a way, it might be a do or die moment, and I think they're seeing the charts just like I'm seeing it, right? Believe me, they have technicians or chartists, and they want to get them. They need to get the price of the S&P 500 and the Dow. Let's go to the daily chart. They need to get it back above the 100-day moving average and the 52-day moving average, because it looks, they're going to start rolling over and start crossing one another, and that could seriously dump the price on equities easily back down to the 78.6 fib retracement at 2500 on the S&P 500 here. So I think they're going to be doves later today. And that will be very bullish for precious metals. Now, can they somehow... This is what they like to do. They don't want to show all their cards. They don't want to show that they're going to be super accommodative to the stock market. So that's why they always talk in circles and tongues. They call it Fed speak. Can they, in a way, dump the metals market by saying we're not going to cut rates, we'll see what's going to happen, we're looking at the economic data? Yes, but at the same time, I think the stock market's going to dump. Now, if the stock market dumps because they're not dovish enough, a knee-jerk reaction in precious metals will be to dump it. And then real quickly, by next Monday, next week, precious metals are going to rise and the stock market's going to keep falling. Why is that? Well, when the stock market starts really falling, traders buy precious metals in anticipation of the Fed coming to save the day and lowering interest rates more and talking about, possibly QE or basically that, right? Just giving the economy another adrenaline shot. Every adrenaline shot helps precious metals go up. Helps the stock market go up as well. And that's why you could see the stock market go up with precious metals. You could even see the dollar go up at the same time, because now why is that? People are confused about the dollar going up and precious metals. That's because the global economy really is slowing, and there's problems all around the world. Europe, China, South America, especially right now, Argentina. So the safe haven knee jerk reaction is to go into cash, which is dollars. So that's the dynamics as of now that I think are going to still play out for at least a few more months, and then we'll go back to the drawing board, right? What are the odds of precious metals falling? Well, here's the deal. If the economic data is actually really good across the board or slightly positive, there might be a few outliers that might actually tank precious metals and make the stock market go higher. It might. The thing is, lately, bad news has been good news for the stock market. Now, why is that? Because bad news forces the Fed for, lowering the interest rates, which injects more liquidity into the markets and produces more lending. Lower rates means more loans. That's how money goes into the system. And if you understand how fractional reserve lending works, you understand it's technically kind of like firing up the printing presses as well. So I just wanted to talk about that for a second. Peter Schiff also had a few great tweets. The Fed claims it's not doing QE, but last week its balance sheet expanded by 88.1 billion. It's grown by 176 billion. That's a lot, guys. It's almost 20% of 1 trillion in the past 3 weeks. During QE3, at most, the Fed's balance grew by 85 billion per month. So the Fed is buying more than twice as much debt when it's not doing QE than when it was. So when it was doing QE right after the financial collapse in 2009, it did less than it's technically doing now, which is insane if you think about it. But this is the new normal, right? And that's why stocks keep going higher and higher despite, companies not doing any better. So what I'm trying to say is, we're starting to get real late in this game, and at some point, we might get a stock market melt up, but this can't go on too long. I mean, it's at the point where the debt becomes unserviceable, unmanageable, and it will take down the system. And you guys have to understand, almost 200 billion is a ton of money. The U.S. economy, in its peak right now of all time, as Trump would say, it's the greatest economy. I can't make his voice. It's what is the economy, like 19, 20 trillion something yearly? And if you take away all of the the Fed manipulation and all the debt, what's the real economy? Who knows? Could be 12 trillion, really? 8? I don't know, because the manufacturing base is so small. I consider that the real economy. And the manufacturing base of the US and Europe is like 10%, somewhere around there, give or take. So I just wanted to let you guys know. That's why tomorrow is extremely important. Extremely. All of these Fed meetings are going to be extremely important. Why? Because it's managed economy. And when they screw up, you're going to know. Or, your bottom line is going to get affected. Your trades, your investments, your 401k, the interest rate on your loans for your vehicles, home, so credit cards. So there you go. All right, guys. That's pretty much all I had. Stay vigilant. Later today, I'll be keeping you guys updated in the free chat groups and the private group. And smash some likes, leave anything in the comment section, share my videos. It's the only way my channel grows and will continue to grow, and I will continue to do this. 10% off. Go to my website, and that's about it. Later.